we are almost at the end of our session. I hope your assignments all done, and we will today, and then we'll rest of the tute we will finish, and then we will look at a question paper and discuss, and then again next week I will touch a little bit on the Basel III requirements. Basel III requirements, I will touch on that. I think with that we will be done with our syllabus, right? So one or two question papers we can look at, just have a discussion, and with that we can we are done with the course, right? Okay, so we were on this last week, right? We looked at what the quality. What do you mean by quality? Now, very basically, we commonly we talk about banking industry. What is the quality of the loan portfolio? That is what decides the bank's standing, financial institution standing, finance company bank their standing is decided by the quality of the loan portfolio, right? Which is very important, which has been looked at by either like whether it is regulator, whether it is the rating agencies, whether it is the investors who want to buy the shares and invest in the company. For anybody, the loan portfolio quality, NPA, how much impairment provisions done, all these things are very important as far as the stakeholders are concerned. So that's why we were talking about the quality of the loan portfolio affects the reputation of the institution, their market standing, their profitability, because if the quality is deteriorating, the profitability will come down, and regulatory requirements, right? Quality has to be maintained, and even for capital adequacy, if the quality goes down, the institution has to provide more capital for that, right? You need to provide more capital for that. That's where we also looked at all this RAROC model, risk-adjusted return on capital model of pricing loans and all that. While we were discussing about the pricing, we looked at that, right? So and then the quality we looked at is decided by what are the factors. You looked at quality. If there's low NPA, yeah, quality is high. Sectoral exposure also decides, because in a particular sector, if the institution is exposed more, anything which is happening in that sector can really put the institution down. And security cover is the kind of a, we call it insurance. So like, the security cover what you have is a cushion on the quality of the loan portfolio, because in a worst case scenario, the quality of the security cover what you have only can save, mitigate the amount of losses you will be faced with. And the provision cover, the more the provision, the better the stakeholders will feel. That means any bad loans, any write-offs is not going to shake the institution. That's the kind of a comfort given by the provision cover, right? Provision cover is what? You are providing for that, right? You are providing for that, for the losses you are providing, for capital non-payment, and then you are suspending the interest, and then providing for the capital. So that's the provision cover, right? So we were also discussing on credit failure. Like, you could just say, all of a sudden this man did not settle, all of a sudden this went into NPA. Like, last 3 months the NPA has gone really up, because now under normal circumstances that's not true. Credit failure of an institution, of a individual customer, Credit failure is something which is a long-term process, which we can't say all of a sudden this happened. It's not an event, right? Why that was not raised? Why mitigatory action not taken? Why recovery actions were not taken in time so that you can reduce the losses the institution can face? Is that the bank has not properly worked on the warning signals, taken timely action, right? This happens many a times. So when a customer is going down, like no return path, where like the customer is overborrowed, unable to settle his financial commitments and interest commitments, he will not be able to meet, no investors are willing to come and invest like that. I mean, when the situation of the business goes down, what happens is that the financial institution which is proactive, which really looks at it and then takes proactive measures and then try to recover fast, recovers first. They will recover first. And the people who just wait what's happening and then subsequently, like, 3-4 months not settled, customer is not coming to the bank, not coming to the institution, and unable to contact and all the time, all these things, when very slowly, when the institution reacts, the chances of recovery is going to be a bit remote, right? That's why you need to be proactive in identifying the credit failure and the recovery. So we looked at the key symptoms, right? So how do you look at how do you say some loan is going to go bad, right? There are so many symptoms. There are so many. There is not one, not two. There are so many symptoms which can indicate that there is something wrong. But by mere presence of a symptom doesn't mean that the customer is going going down. But maybe it's a thing for you to review and see whether everything is okay, right? Whether this is manageable. So deterioration of financial affairs, of course, will be reflected in the kind of turnovers what you are having, account turnover what you are having, and the kind of whether the facilities are becoming hardcore, right? Whether the customer is issuing more checks than the credit which are coming, right? Deterioration of financial affairs. Attempting to disguise the deterioration through creative accounting and other approaches. So a lot of companies do this. Customers try to do creative accounting, right? Trying to hide the real scenario, right? So we are fellows. That's why we look at the accounts. When you are looking at the final accounts of a customer, we first see that whether it is qualified, whether these guys are messed up with any accounting standards which they are supposed to follow, which they had been following. So the creative accounting, whether something is happening, we also call it kind of window dressing, right? Hiding the facts. So there are many ways to do that. Sometimes people will, meddle around with the stocks. So the moment you increase the stocks, what happens is that your profitability can be affected, right? The whatever stocks what they have, if they show a lower stocks, what happens is that the profitability will be shown lower. This is for income tax purposes. People will do that. They will show lower stocks. When they then the existing, if they show a lower thing, that means they are charging more to the profit and loss account by way of cost of goods sold. That means they are bringing down the profitability. But on the other side, if more than what is available, if they show more stocks, or the stock value is higher than what is actually present there, that means they are kind of trying to inflate the profitability through maneuvering with the stocks, that kind of a thing, right? So like what I told you, one major company also sometime back, they tried to, I was going through the accounts to see that they have changed their depreciation policy. So when you meddle around with the depreciation, so when you bring down the depreciation amount which is going to P&L, also profit can be high, you will show a higher profitability, right? So these are few things why we actually look at the cash flow of the business. If the cash flow, if the business is not generating enough of cash flow to pay your loans, they won't, with all those kind of manipulations, they can't hide the fact that they don't have cash flow, right? So that's why we started looking at the cash flow more, right? So attempting to disguise the deterioration through the creative accounting and other approaches. Behavioral changes of the management. So management sometimes, they may avoid, they may stop visiting the banks, and when you call, they are not available, calls are not answered. Frequently, they say he is not in office, he is abroad, and all that kind of things. All these behavioral changes, which is a alarming signal, right? And then when you simply look at the customer's current account itself, you will see whether there is hardcore formation. Hardcore formation is what? The customer is operating above a particular level in the current account, maybe to the at the OD limit or above that. It doesn't come down there. It doesn't show the fluctuation, but it should have for a, I mean, the working capital fluctuation should be there now. Amount of, if you are given a 10 million working capital, it always should come to nil and credit, and then go and utilize and all that. That's how it should be. So declining current account performance, hardcore formation is a signal. That is why time to time, but we look at it and then we say that, if the business is okay, we take that hardcore portion of that separately and then put a term loan, right? Hardcore portion, we try to take it out because that is hardcore. That is not really serving the purpose of working capital there. So you pay it back over a period of time rather than keeping that. So because if a hardcore balance is there in a current account, that means that there is no arrangement to pay that, right? Customer keeps on paying the interest, and so there is every risk that if it goes like that, it can become a non-performing advance. So that's why when we are restructuring or rescheduling, we try to take that hardcore portion out and then give a term loan for that hardcore portion, right? So hardcore formation has to be followed. Then the other one, like what I told you, outflow. When the outflows are more, means if they are paying more, then the trade receivables inflow, right, from the actual business what they are getting. So it shows that customers' commitment is much higher than what we think. Outside commitments are high, and then maybe business, the debtors are not paying, right? Debtors are becoming toxic. That means it's a problem, right? They are not paying. It become toxic. So outflow more means from the account they are drawing out more. Maybe they are borrowing from outside the lenders also. So their interest also might be going. So we need to look at the checks which are being paid through the account also when we want to see that, right? Then check returns. Frequently, fund not provided, checks are returning, right? And they tell excuses. Check payment will come, all that kind of stories, right? And many a times they give stop payments. Not that we can't stop a check, but if the customer without funds, he gives stop payments, means there's something wrong, right? That means he is not able to meet the checks which are coming to the account. That means he is not getting the payments from the debtor. So from the business, he is not getting the payment or cash or checks. He is not getting, right? So that's a warning. Check returns. Then stop payments also same. Then round figure payments. Now normally any business, any payments, hardly there will be round figures, right? 10,000, 20,000, 50,000, 100,000. right? 1 million, 2 million. Like the round figure payment is not wrong, okay, but increasingly if you are getting, that shows something else, whether they have borrowed somewhere and then paying these by way of capital, right? Many a times what happens is that people go and borrow from external money lenders. Now, external money lenders, you should know. Those guys, what they will do, they will give the cash, deduct the first month's rent, interest and give, right? So they, let us say somebody is charging 5% per month. So when someone is going and taking 1 million, they will give 950,000, right? Payment 950,000. Then thereafter they will say from the second month you will have to pay me 50,000 a month. And the capital to be repaid also they will have. So what happens is that when you are finding checks which are coming like, like 100,000, 50,000, like, not a good thing, because these customers would have given their PD checks, signed PD checks to the money lender, right? That's the normal way the money lenders operate. They will say that, good businessman means, okay, give PD checks, sign and give the PD checks, we will deposit. Other people, if the money lender doesn't trust me, they'll say, okay, give the mortgage, give the property deed, right? A property deed. So sometimes these guys will sign a transfer document also, sign and keep it. The moment the loan is not settled, they will transfer the property also. They are very powerful. Informal money lenders, right? So their operation can be seen from this particular current account operation, and you need to look at it and then ask questions from the customer. You can't say the checks are coming, all right, no problem, right? There can be a problem. And the other popular problem is that people don't give the audited accounts or MIS on time, right? Non-submission of data or non-availability of financial information. You ask several times that there are things, stock statement, yeah, you ask MIS, you ask audited accounts, which they had been doing earlier, but now it's getting delayed, okay, or they are telling excuses, right? So that's not a good sign. And then, people who are avoiding the bank and all that, coming out with excuses, it's not a good thing. The delay in settlements, delay on unretirement of import documents. Many a time what happens is that people open LC, documents have come, documents are coming and waiting, they are not retiring the documents, right? It's that means the customer is in trouble, right? So what happens is that if the shipment takes time, means document can come in advance and then shipment will come. So when the ship comes and reaches, the customer will know. Then on the day you will come in, try to come and clear up the documents and take and go. But if the goods have come to the ports and then if the documents are waiting here, the demurrage, the number of days the goods are going to wait at the ports until the customer goes and clears up, that will be penal. That will be high. That will really eat into the profitability of the customer. So if the customer is delaying retiring the import documents, it's a bad sign, right? It's a bad sign. So delayed on non-retirement. Now LC means bank as a liability, right? If the documents are submitted in accordance with the LC by the exporter, right? Documents have come in accordance with the LC. Bank will be debited. Bank only will have to, on receipt of the documents within 3 days, if there is any discrepancy in the documents against the LC, bank has to inform. The bank doesn't inform, there will be a reimbursing arrangement. Reimbursing arrangement is what? Your bank or your financial institution will have an escrow account. That account will be debited, and the presenting bank, the exporter's bank, will recover the funds. So because you would have given a debit authority. So it's a commitment on your institution. If the documents are submitted in accordance with the LC. So if the customer doesn't come and retire, now if it is on a other terms, not a letter of credit, if there are collection basis, documents have come, customer has not collected, no problem. We can look at it and then inform the sending bank, and then we can return it back. We can say the customer is not collecting, right? So collection base is not a problem, right? But if it is LC, bank has a problem, because bank has a commitment. The moment bank opens a LC for an import, bank gives the commitment to the presenting bank, to the negotiating bank, that we will pay. So the exporter's bank will have to pay, so far as the documents are in order. And the other delayed on submission of export document also is a problem. A minute before exports, for the exporters, what happens is that many a time we give pre-shipment loan, packing credit loan, all that. So pre-shipment loan is given for the purpose of buying goods. Many of these fellows, if you find that the tea exporters, the other agricultural produce, cinnamon exporters, cocoa, and all the time exporters, what they will do, they will come and ask for a pre-shipment loan. So you will give a pre-shipment loan for them to procure the items. They will procure and process and send it. Processing is what? Packaging, and then sending it to, they will export it to their customers overseas. And on exporting, either at that point of exporting, the export documents, they can come in, it can be discounted, it can be purchased. Export documents can be purchased, in the sense, you advance to the customer on the export documents and then settle the pre-shipment loan what you have given, right? Or else it is exported and you give about 3 months time, 3 months or 6 months time you give, that from the time it is exported, basically from the time of you giving the pre-shipment loan, within 6 months the payment should come, right? Within 6 months, 3 months or 6 months, the payment should come. So the customer will process an export and he will get the payment down, and then from that payment you will recover your pre-shipment loan. So if customer has taken any packing credit loan or pre-shipment loan, and he is not submitting the export document, means there's a problem, right? There's a problem. Why? So he has taken, so goods he should have bought, and goods should be exported. So whether he has done something with that, with the goods, so whether he has sold it to somewhere and then not exporting, right? It's a problem, right? So delayed on submission of export documents is a problem. Frequent requests for temporary facility. This is very frequently in the branches you will find. People ask temporary facilities every time. Give a TOD, give a TOD. So you would have given OD on top of it. You will have to, if customer is coming and asking for TOD, then it's not a good sign, because we assess the customer. We review the customer's operation. Based on that only we give the facilities. Facilities are given. On top of it, if they are coming and asking, that means we haven't properly assessed. Or from the time we assessed, there is a substantial increase in business, right? So that current working capital facilities are not sufficient. If there are no other reason, if it is the same, still the customer is asking for TOD and all that, there's something wrong, right? There's something wrong. So you need to look at it. So getting a TOD, of course, we don't do that much of a assessment. Because those are, for urgent commitments of customer which is given, but it cannot be a regularity. So if the customer frequently asks, means that's a danger signal, right? Then non-renewal of insurance. Many a time this happens. you have so much of fire insurance and so many other insurance, life insurance or fire insurance. So like if it is a building, you would have covered. If it is machinery, you would have covered with fire insurance. If it is a vehicle, you would have covered with comprehensive insurance cover. So there are so much of insurance related documents are there. If the insurance is not renewed, the problem for the institution is that I mean there's no security, right? So if for a vehicle, if you don't have insurance and then it has gone and met with an accident and then it partially or fully it is destroyed, I mean then you don't have security cover, right? If insurance is there, you will recover and then that payment will come to the bank, so you can cover your exposure. So non-renewal of various insurance, right, is not a good sign. It's a warning signal. So financial statements also, when you're looking at the financial statement year on year, when you're looking at it, you know that, I mean, from the balance sheet, you can look at the net worth. Net worth of the customer, if it is going down, means why net worth will go down? Net worth will go down because profitability is low and your liability is higher than the assets. So due to that, your net worth is going down, right? Your liability is going up. So deteriorating net worth. A deterioration of ratios. This is where the ratio comes. So you look at the ratios, different ratios. You look at net profit margin, gross profit margin, return on assets, right? Return on capital employed, right? So DSCR, debt service coverage ratio, different ratios. When you're looking at it, there is deterioration. That shows business is going down, worsening cash flows, right? Revenues are going down, cost is going up, right? There are so much of things. For a person who understands P&L, profit and loss account, and balance sheet and cash flow, it's a kind of a reservoir of information on the customer. So far as the accounts are prepared somewhere close to the reality, right? When you're looking at listed entities, respected entities and all that, mostly the accounts will reflect the true state of affairs. But if it is like, private companies, individual investors, individual customers and all that, sometimes the account may not be reflective of the true state of affairs of the customer. There may be a lot of window dressing or creative accounting, so that you may have to look at other avenues of identifying the correct state of affairs of a business, right? Such as, if you are looking at a business, you will go to the business and then you will look at see how much of daily sales customer is doing. From that, you will try to look at if they are doing daily sales, let us say 1 million. So for a month, they are open for about, let us say 22 days, they are open for a month. So 22 million for a month, and then 12 months, 12 into 22 million, this is the turnover. So whether the business turnover is reflected in the accounts. When you see that, you will find that, okay. So when you go and just look at a stocks figure, physical stock, you take a stock and then stock valuation, where you ask the customer to put the valuation, correct valuation, and you. So that valuation, physically you look at the stocks and put a valuation, and then go and look at the inventory figure, whether that is reflective of the true state of affairs. So there are ways you can look at it and then say that, what is the difference you get when you are looking at the actual scenario in the accounts given. But mostly the reputed companies, reputed individuals will not meddle around with the accounts, but there are enough of people who will do, right? And you will find if the fixed assets are being sold, there should be a good reason why the customer is selling fixed assets. So whether due to compulsion of settling some other creditors, whether they are selling and settling. So we will go into that tendency why it has been sold, whether it is a normal course of business is selling and buying and all that, or else there are some other issues. So sale of fixed assets, worsening cash flows, right? Cash flows, cash flow constraints you can easily see that from a positive, if it is turning to negative, cash flow negative, this one is not a good sign. Or cash flow from the beginning and ending cash flow, when there is lower cash flow at the end, there has to be good reasons for that. Otherwise, there are problems. Falling revenues, right? Rising costs, all these things are showing that the business is not doing well. The other problem is that evident, many a times it is evident, people who are working, very trustworthy people, who only deal with the bank and so many responsible jobs, like run the factory or run the business or run the sales operations and do the purchasing operation, like trusted the employees. You find that people leaving. Then it's not a good sign. People are leaving the business. Why? Right? So maybe business is not doing well. They are not satisfied. Right? They are not satisfied with the future of the company, so they are leaving. Right? Employee turnover can be there. It's not that you can't have the time fully everybody will be working. But then if you find key people leaving, it's not a good sign. Right? Strain on senior management. Right? Now, while you are talking itself, you can see that whether the customer is getting into a kind of a negative mode, right? Trying to be desperate, right? Trying to be desperate, trying to show their impatience, trying to sort of manage, trying to give promises which cannot be kept, right? Just to, postpone the inevitable. People will come out with various excuses, various unsustainable ways of. So I was recently talking to a customer. Actually, this customer has a very good security cover, so I have no problem with the security cover of the customer. So he has, he has about 700 million or outstanding. So when I was looking at it, this guy actually operating from another country is not here. His employees are here running the company, but the company operation itself is not sufficient to kind of uh, run the operations as well as pay the bank outstanding loans and installments and all that. So these guys are going on moratorium and all that. So we know that business is in trouble. So he comes out with various excuses, telling that there is an equity partner I'm trying to bring from this country. I'm in US. I'm bringing equity partner. They will come and invest. From that, we will settle off the bank loans and all that kind of stories. We know that this is they are coming out with the stories and then they are only postponing the inevitable, right? So they are trying to say excuses and then they are trying to postpone the inevitable, right? Maybe an investor will come, but current scenario is a little bit unlikely. So we keep ourselves ready. What is the next course of action we have to take? Kind of. So the strain on the senior management, the desperation, while discussing, you will know which way whether business is going to be revived, whether they have enough plans to revive it and then increase the turnover and sort of meet with the commitments, or they are trying to bluff and then postpone, right? So it is apparent, it will be apparent with the bankers as well as when the way they are dealing with the creditors, suppliers and the staff also, that will be apparent. Then the other thing is customer normally is he bargains For rates they bargain, for the loans they bargain, right? To get the better terms. Of late, if you find that they are not bargaining, right? You give a TOD, you charge 15%, that's okay. You anyway give the TOD, right? And then trying to switch accounts between the banks. Bad scenario where we ourselves in the industry, we sometimes spoil the customers, right? Somebody comes and talks and then says that, I mean, I have so much of facilities with that bank, and if you give better terms and then give me 100 million more, I will bring all the accounts to you. So here the customer is trying to create more working capital for him through another bank, and the bank is going in, I mean, they are transferring all the accounts elsewhere. So the switching of accounts to another place and then asking for more working capital and all that, those are kind of a warning signal, right? That means they are not doing well with that bank. That means their relationship with that bank is not very good. If the relationship is not good, it is not with the lending officer or whatever. It may be that, I mean, their performance is not good. So here they are trying to come with that particular problem to this bank. So got to be very careful as lending officers, right? While customers switch their accounts between banks, you need to take it with a pinch of salt. Sometimes it's a business opportunity, sometimes it's a trouble you are taking from other banks, right? Many a time, depending on the customer's regularity, the suppliers will refuse credit terms. So if the customer was continuously to the suppliers delaying payments and all that, they will slowly reduce the credit term. They will say, I can't give you 3 months, you will have to settle in 1 month. And later they will say, okay, earlier I was giving you 500 million credit line. Now we are not able to, we have reviewed that. So currently we can give only 100 million. So anything more you want, you'll have to pay cash and take it. Something like that. The suppliers will have their own managing. They will manage it and then they will reduce the, so they reduce to extend the credit or restrict the credits and all that. That means that's a problem. Then the one, what I was telling you, financial technique, they come out with various techniques to sort of say, we are going to, that's where the story. Now, like what I told you, customer telling that we are going to bring in equity investor. So it's hard for me to sort of imagine that equity investor from US will come with so much of fund. As you look at the business and then as you look at the balance sheet and then, outstanding bank liabilities and all that, it shows that, I mean, it's an alien company. So whether they will be willing to come and put in a country like this, in a company like this, I mean, those are things I say that, I mean, we'll have to take it with a pinch of salt because may not happen. This may not happen, right? So we need to have our backup plans. So they come out with various unsustainable financial techniques. They will say that, I mean, we ask for a loan, we are trying to raise from the family circles, we are trying to raise capital, or like from a money lender borrowing, right? So sometimes people who are dealing with kind of a leading commercial banks going and asking from finance companies at a higher interest rate, right? At a higher interest rate. There's nothing wrong with borrowing from that, but then when they are finding it difficult, even at a lower rate with commercial banks, when they are going for a higher interest rate, that is a thing. I mean, if they have the cash flows and all that is okay, but they are borrowing at a higher rate means, okay, those are things which only postponing the problem, right? Higher interest rate means that's again a vicious circle. So to pay that loan, they will have to borrow from elsewhere, right? So those are actually warning signals you must keep in mind. This is an important area for you as a lending officer. Okay. So your credit monitoring, what you simply by the term credit monitoring you understand is that you track the performance from the point you are going and dispersing a facility, right? You are doing an appraisal and then after that you are, getting the appraisal proposal approved by the approval authorities, and then you take the security documents and all executed and disperse a loan. So from the disbursement of the loan until it is fully recovered, that part is your credit monitoring. So where the credit monitoring is not very strong, the financial institution will have problem, right? So the tracking of all the loans need to be maintained on a real-time basis. So post-sanction mechanism is very important to look at the performance of granted loan, right? So because down the line after dispersing the loan, so many things can change, right? Customer can fall into trouble, regulatory environment can change, right? The interest rate scenario will change, and sometimes we may be forced to revise the interest rate. That can put a strain on the customer's work performance. Customer can go out of business, and the customer can have problems in business, in the industry and all that. So many things. So that's where your credit monitoring comes into being. So many of the financial institutions now, they have ways of tracking. Like, I mean, even before the first installment is due, informing the customer by way of SMS, right? Calling the customers and reminding, sending an mail to the customer that this is becoming due, so please provide the funds. So like proactive thing. So 1 installment, 2 installments, so that, I mean, you don't allow the customer to accumulate. The moment you allow the customer that, I mean, okay, only after 3 installments it is NPA. So when it becomes 3, you settle 1 installment, you keep 2 installment or something. If you allow the customer that kind of a comfort, what happens is that customer, it will be habitually, he will get used to that. He will always keep the 2 installments overdue, right? So his cash flow pattern will be that. So cash flow pattern will be that he always can afford only 1 installment. So he'll always put the 1 installment. So that's a bad practice. So we should not allow that to happen. We should not allow the customer that the comfort of keeping 2 installments overdue. When it becomes third, you recover 1. Not a good practice, right? So there are banks, there are many institutions, they have this particular continuous tracking, right? One is overdue, not settled, continuously run behind to get that settled, right? So recovering 1 is easier than recovering 3, right? So we were looking at various risks which are important in your assessment. So you will be looking at the management risk, people's competency, right? What is their succession plan? How is the management is being done, right? How the management is whether competent people are managing, and then their turnovers and all that. So those are management risk, right? If there are any change in stakeholders, if the company is being taken over by another company or somebody else is investing. So the risk appetite changes with the some new investors coming in. All those things will have to be looked at under management risk, right? So competency of the people who are managing is very important, right? And the market risk, we looked at the market risk. So I told you market risk when it comes to a financial institution, a bank, and the market risk for a customer is different. In banking parlance, a market risk means basically we look at bank's assets, right? Mostly the assets what we have put in the say treasury bills and bonds and other investments and kind of and our nostro balances. If we have invested in gold and all that, All these things, I mean, whatever invested by the bank, in that, in the market, what's going to happen? Interest rate changes, gold prices going up and down, right? Treasury bills and bonds changing, other fixed income securities where we have invested changes. If we have equity portfolio, equities, listed equities, prices going up and down in the market, so many things, right? That's market risk for the bank. When it comes to customer's market is that his business. What is the business he's in? So what he is manufacturing, what he is selling, what is the service he is delivering, right? So whether there is any demand shift, right? Whether there is any demand shift, whether demand is going, whether his product is, uh, you know, being won over by the competitors, right? The demand is going to some other product in the market, competitor product. So demand shift, whether cheaper competitors are coming into the market, right? So that they are losing. Policy changes in the government due to that their market is changing, right? Like policy changes for the tile manufacturing companies now, like I mean, Lanka Wall Tile, Royal Ceramics, Lanka Tiles, right? All these companies recently had a boom because the government policy change, government embargo on imports of tiles and all that, right? That boosts business, right? Uh, really increases the demand for the goods, and even Lanka tiles, I hope they showed that, I mean, all-time high sales they achieved in December, right? Something which never happened in the past. Uh, so the market, so those are the market risks, right? Protectionism, that is one way of protectionism. If the government is stopping any imports of goods and then uh, kind of promoting local products, that is protectionism. In the modern economic scenario, it has to be handled very carefully also, because when we stop imports, what we have been doing, uh, that exporting countries will make a fuss with the other exports what you are doing to that country. I say you have stopped importing these products and all that. So we also will restrict the amount of goods what you are exporting to us. So if we say, for example, we are exporting tea, say for example we are exporting ready-made garments, they will say we are going to restrict your exports. So those things we'll have to handle it very carefully, because we are into a kind of a vicious circle where, like, I mean, we need to be, run the affairs with all the countries also in a very cautious way, right? Then other thing is that's about the market risk. Financial risk, risk is what? High overhead costs, right? Customer is having expensive office office maintenance, paying high rent, paying high salaries, maintenance staff, I mean, in the sense administrative staff salaries are high, management salaries are high, right? Which is not very sustainable. Then it's a problem, right? Financial risk, high overhead, high leverage. It's a problem, right? High leverage is what? You borrowed more, right? So far as there is a balance between how much invested equity, how much borrow, no problem. If the borrowing is more, it's more strain on the business, because they need to pay more interest, more installments. That will be a strain on the business. Yeah, they are working capital will be limited, right? So the finance cost is high, means risk is high, right? The regulatory risk is that changes in central banks policies, changes in government policies, changes in central environmental authority policies, changes in tax rates, right? Business tax rates, introduction of new taxes and all that. Those are regulatory risk for a business. The sectoral risk, when you look at it, if for example, let us say uh, your financial institution exposed to building up this uh, high-end condominium properties. Let's say in Colombo 1 and 2, the high-end condominium properties for which your exposure is high, your concentration is 40%. That means that's a risk, sectoral risk, because in that sector, the developers are finding it difficult to sell the apartment units. If they are finding it difficult to sell the apartment units, there's a concentration risk, right? Because the 40%, if it becomes non-performing, it will be a huge strain on the bank's performance, bank's quality, bank's NPA, bank's lending portfolio, right? Okay, so lending in high risk sector, lending in high risk sector. Now you have an integrated risk management department. Your risk management department, time to time, looking at the market, time to time they will categorize the risk sector, right? Low risk and high risk sector, they will categorize. So going and lending in the high risk sector is a sectoral risk, right? So condominium is one area I told. Construction industry, let us say, construction, like let us say when there are issues, labor related issues are there, like during COVID period, labor unavailability, unable to construct, and all the strain on the companies high, right? Because they have to invest and wait, so the construction period will get extended by years. What they wanted to finish in 2021, they might go up to 2022 or 2023. So those can be high risk sector. So lending in high risk sector uh, shows sectoral risk, right? So what is the percentage exposed to? That's important. So how do you manage the risk, right? How do you manage the risk? Risk mitigators, mitigatory factors in managing the risk. So periodic inspection is one of the very important mitigatory factor. So it's not like calling and asking somebody or personally going and visiting. So periodic visit will show how the business is running, whether the customer is having same amount of business like earlier, whether turnover is okay, how is the customer's stocks, what is the age of the customer stocks, right? Whether the customer is maintaining age-old, stocks, which may not have value now. How is their debtors position, creditors position? When you go and just have a on-the-spot checking, a lot of things will come out, right? So periodic inspection is important. Systematic analysis of financial statement is an art. You should know how to look at it and get the conclusions. Right? Systematic analysis of financial statements, right? And that is where we were talking about the ratio analysis also. Risk-based review frequently. You look at the review, whether risk, customer's risk level, whether it has deteriorated or improved, right? So your credit appraisal will have a risk rating of the customer, right? Based on the risk levels of the customer, there will be a risk rating, right? So that will be reviewed periodically. Periodically, it has to be reviewed, right? So risk-based review frequency. Frequent customer engagement. Now, that's very important. We must keep our ears to the ground and frequently engage with the customer, right? Talk to the customer, making more opportunities to casually meet. I won't say casually meet, some opportunities to meet. Okay, increasing the visits, or you may have customer sometimes get-togethers you would have organized, and then you will call them for it, and then occasionally you will meet at a luncheon meeting, like call them and then discuss about the business over a luncheon meeting. So like that, I mean, so frequent customer engagement, frequent analysis of customer MIS. Look at the MIS. So the customers who are not maintaining proper audited accounts, their MIS will throw some light into that. I mean, because MIS is internal management information, right? Management information. So in that, of course, they will largely show the correct, sales and profit figures, sales, profit, and balance sheet and all that. I mean, they will show almost the correct figure. So frequent analysis of customers MIS will show the trend in the business, right? Industry trend. What does it do? Somebody is in the printing industry. In the industry, what's happening, right? You look at the trend. Somebody is in the let us say commodity industry. In that industry, what's happening? Somebody who is an import of sugar, you will look at, I mean, how are they faring now, whether there are problems, right? Now they are able to manage, right? Whether they have overstocked and waiting now, unable to sell the stock because the duty has come down, that kind of issue. The industry trend and assessment. Then the market reports, there are so many market reports you all will get, right, about different industries, different in the economy. So look at the market records, right? And then this is most often we don't do, but that's a integral part of lending, is that giving the customer suggestions. Why don't you do this way? Why do you why are you hanging on to this particular product? I mean, from your accounts, we find that, I mean, you're not making profit from that line of business. So why don't you review that? Why don't you look at more sustainable products? Like, so in borrowing, out or in restructuring their affairs, in the investment strategy, when they go for a high-priced asset, you will say, oh, why are you doing this? You have working capital problems. You are trying to, in your fixed asset, you are trying to go and, get stuck more. You will find it more difficult for your working capital. So is the time right? Like, I mean, not as a matter of giving a loan and then increasing our loan portfolio and then showing our performance. We should be a proper advisor to the customer to put them on the right track. Because we were not doing that, we have a whole lot of customers who have gone into an NPA and then struggling, and then now on the verge of selling their assets. So when you talk to them, they will say, the bank should have told us. So, okay, in business, we went into this and all that. So when the bank knew, if the bank had told us, we wouldn't have done that, right? Sometimes what happens is that I have come across cases where, let us say there's a sick customer and his assets are there. We go and negotiate with a person, with another customer who is kind of doing business, not really extremely well and a lot of cash flow, but then he's managing well in business and all that. We go and say, why don't you buy that property? We will give you loan, right, to buy that and all that. Well, let us say that particular giving that loan puts more stress on the cash flow of the customer, and then he is going to struggle in running the business. But still, we want to get rid of another NPA customer. We go and promote and then give it to that customer. Then what happens is that we are putting a good customer into trouble, right? So far as that customer can create additional workflow and then pay this loan also without a problem, that's a different matter. But if you go and put more strain on a customer, with that he is going to be in trouble. But to get rid of an NPA customer, when we are doing that, we are putting a performing customer into trouble. This happens very often. I have seen that happening very often, right? So we have to be a good, a customer is a partner for a bank, right? For a bank, they are a partner. So their growth in the right path only will help the bank to flourish. Right? If you can just go and try to give all the loans to the customer, unsustainable solutions, suggestions, and then put the customer into trouble, and then we get our interest in all that, increase our profitability. That is not sustainable, right? That's not sustainable. That is something the lending officer should understand, right? If you are a mature lending officer, you will understand that. So how your non-performing advances form? The reasons, like what I told you, improper structuring. Many a time I have seen the people who have gone into non-performing section, their assets are structured in an improper manner, right? Especially when the customers, for the customer, when we are giving a composite of facilities comprising of overdraft, term loan, import line, export line, right, other factoring, leasing, vehicle loan, all that kind of facility when we are giving, many a time we structure it wrong. And improper structuring ultimately leads into facilities becoming non-performing. Many a time I have gone and seen that they have given overdraft facility for things where they should have given term loan. They have increased, or some loans or advances given lower than the customer's appetite, lower than the customer's operation, so that customer goes for high cost borrowing outside, right? So the structuring is very important. As the unsustainable leverage, and the customer, goes and borrows more than what he can repay and keeps on borrowing, and increases the leverage in the business, which is basically will put the customer into trouble. I have come across in my career many customers. The customers are in the front line. They identify. They look at businesses. Say, for example, next door there's a hotel running, and then that man is now let us say the father died and son wants to sell the hotel. This man who is running a hardware shop next will get an idea. Why don't we buy that hotel just next to me? We can run that hotel. And okay, so we'll kind of get the idea. We'll go and give the advance, and from the hardware business he will put some cash flow going into that, then come to the bank, then try to take a loan, put the pressure on the bank, try to take the loan, they take the hotel, and ultimately that hotel becomes a drain on the business, and even the hardware business also will fall into trouble because he doesn't have experience in the hotel trade or running restaurants and all that. This happens. Sometimes people succeed, sometimes they don't succeed. So the customer pressure, right, that can create NPA. External influences, like what I told you, right? So many other market stimuli can push the customer to go into certain areas, certain risky areas, which can really put strain on the working capital, and then the customer becoming non-performing advanced customer. Mismanagement is a common cause where the way of running a business, some people are in it, they know in and out of everything. The other day, I was meeting a big businessman who has showrooms in the country, around the country, a showroom outside the country, and he has hotels, he has kind of a fashion stores, and furnitures, whatnot. Big businessman. When you go and meet him, when I talk to him, I identify that this gentleman very simple and all that, but then everything in his head. He knows how much of investment, how much of business he has, where and where, what is his cash flow, how much of money borrowed from the banks, and then how to, rearrange the borrowing. All that it is there. Like, I mean, very simple type of person. I mean, you will find it difficult to get that kind of information even from a well qualified CFO. CFO will come out with his, presentation. But this gentleman just says, offhand, he says that, I mean, that's an involvement in the business. They know that. I mean, some of the people will only depend on people who are managing, and they give all the liberty to them. So the managing people many a time mismanage, right? So unless the stakeholders have kind of a control and then review process, many a time the managing people will do the mismanagement, and even the owners also mismanage. And the owners also mismanage. That can go into an NPA formation. So, like what I told you, many people will take bank loans and then go and invest into their things which are not going to pay back. In the sense, I mean, maybe expensive house, expensive vehicles, and all that. No, I mean, no problem in going and investing in that. That's perfectly okay. But if it puts a lot of strain on the business, and their working capital is going to go down, repayment capability is going to go down by doing that, that's a problem which the customer doesn't understand. So for him, like, I mean, going in an expensive car, living in an expensive house, uh, you know, gives a lot of social boost and kind of, boosts his ego. But the problem is that he may not understand that is going to slowly kill the business, because the strain what he is going to put on the working capital of the business by way of repayment of these loans, so interest and everything. So changes in customer lifestyle, unsustainable means it's a problem which will end up in NPA. Labor unrest is a famous thing. It can strike at unexpected times for the customer. So managing labor is unrest is a skillful job. Many times I have seen businesses are closed, factories are sold off because of labor unrest, right? Employee infidelity is that employee cheating, right? Employee cheating, that happens from the down the line, it happens. Unless we have proper checks and controls, internal controls, systems, procedures, this is a problem. So employee infidelity, loss of capital can end up in pushing the customer into non-performing advances. For a customer who is in the trade of selling items for fashion, style, and trends and all that, changes means can be a problem. Sometimes customer can go out of business. Technological advancements really puts the businesses into a kind of a spot where sometimes they may go out of business, right? Technological advancements. Um, Now people are okay. Let us say you have a customer who has a building in a primary location in Colombo. We know we have whole lot of people, companies which are renting out space, A class, space in Colombo, renting out that kind of a setup, huge spaces. If you have a customer, if that customer is depending on the rental income or from that building for all his operations, other things. Now, With the current COVID scenario, people are working from home. Companies are reducing the space from which they are operating, and the offices are being shrunk. People are just not renewing their lease agreements. They are moving into a place, less significant place, so that they pay a very less rental, so that many employees do not visit office, they work from home. So I mean, this technological advancement putting them into uh, a bigger issue. The other day, one customer, my officers were going to canvas, that's in Kolpiti, close to Bambalapiti, huge building. And it's about 11-story building they have put up, and then they are conducting classes, and a lot of spaces have been rented out. And so to put up the building, they have taken a loan from a bank. So this bank, those loans are running into kind of a billion or so. So repayment capacity is coming from all this rental income and all the time. That's where, and then they have some of their own business and all that. Now they are coming uh, or talking to my officers. My officers are going and looking at it as a business venture to lend. When I look at it, they have already borrowed on a 7-year term from that bank. Now the customer is coming and asking whether I can give a 15-year loan, right? Why? Because installment size is high. They are not able to meet the installment. They haven't fully rented out the building. Now there are no takers now. And we know for a fact that it will be very difficult to rent out now. It will take quite some time, right? That too, the companies like IT and service-oriented, the people who can work from home, those companies are not going to rent out premium spaces like that. So this company is going to be in trouble. So I had to say sorry that for the time being we are not interested in this, right? So technological advancement. Natural disasters can force into that. I don't have to say. Due to tsunami, how many businesses fell into trouble? Due to floods, right? Due to cyclone, various reasons, right? So why you all are creating provisions? When you're creating provisions, so when you are suspending interest and you make provisions on the capital outstanding of the customer, you try to show the realizable value of the asset. So you keep the realizable value of the asset. Progressively you do haircut. The more the advance in the non-performing section, you, according to your haircut thing, you progressively reduce reliance on the asset, right? Up to 40%, like on the asset, fixed asset or property mortgage, right? So to show the realizable value of the asset, and then you need to show a realistic figure in the balance sheet. So if a customer is not paying, then it has to be properly reflected in your balance sheet. So that's why you make the provisions. You prepare for the worst, but you do that in a gradual way, and also to comply with the regulatory requirements. So this practice is what giving kind of a comfort for all the financial institutions, where there won't be a sudden huge impact on the balance sheet and profit and loss in balance sheet. They say this bank overnight fallen into trouble or whatever. So bank keeps on preparing for that. Gradually they prepare for the worst, right? Prepare for the worst, so that you don't go and park every amount in 1 year, right? Gradually you do that. We'll go into now bad loan recoveries. What do you do, right? What are the ways you do the bad loan recoveries. So why do you have to reschedule a loan, restructure a loan, right? Why? So why do you want to reschedule? Is that reschedulement is about customer's current position is changed from the point where we assess the customer, looked at his repayment capacity. Based on the repayment capacity, we have given structured and advance, structured one note, composite of facilities. So that has changed. So if it has changed, customer's repayment capacity has come down, right? Then what you do, you need to change and give a lower installment for the customer to pay. Otherwise, he will not be able to pay. So that's a very recent government also gave this moratorium where they said, I mean, for 6 months period, you don't have to pay capital interest or some areas where capital moratorium given, interest was to be paid, right? So for tourism, the hotels in the tourism industry, for them maximum even up to next September 2021, it was given because of the reality that tourism may not be revived that fast, right? The companies may not be in a position to service the loans. So due to that, longer moratorium given. So when you're talking about rescheduling, you reschedule the payments so that you try to reschedule the payment of loans so that you extend, you reduce, right, the loan repayment. But restructuring, of course, you will look at okay, this kind of current structure is not going to work. Let us say you have 10 import demand loans given, customer brought down goods, unable to sell and settle. You have 10 ideals for demand loans, which are becoming overdue. You have given moratorium. Moratorium period is going to be over, but he can't pay because the ideals has to be paid. Bullet payments he has to make, import demand loans. What is expected is that goods imported, he should sell, and one shot he should pay it off. Then what you do, let's say all the 10 ideals, let's say every ideal is 1 million, so 10 ideals, 10 million. What you do, you will go and say that, okay, current scenario is bad, you are not able to settle, right? Your overheads are high now, due to COVID scenario, you are not able to collect, all that is fine. So all the 10 ideals will make it one term loan, repayable over a period of 2 years time, right? And you give the customer to pay in installments. Okay, 24 installments for you, right? We put all the 10 ideas, 10 million that is to be repaid over a period of 24 months. So a lot of, you are creating comfort for the customer to pay, so that you are restructuring, right? Okay, then we by doing this, what we do, we kind of being flexible with the customer's current repayment capacity, rescheduling, restructuring, so that we reduce the possibility of the loan getting into the non-performing advances. And you see, if you are taking a customer to courts, if you are filing case against the courts, if you are going for parate execution against the customer, that's the last thing you would like to do, because the lending is a kind of a relationship. Bank with the customer, the relationship, what you mean, it has to be smooth, it has to be very cordial, it has to be smooth, and you always should try to safeguard that. But we go into all these recovery actions only as a because the institution is desperate, unable to, the other methods we tried and it's not working, then only you go into that. So this is one of the way we try to mitigate that, stop that, right? Save the relationship. So avoid unnecessary legal battle to recover. And also central bank also wants this to be done. A central bank will not allow you if you say the customer's cash flows are not there. You haven't taken the customer's cash flow forecast. There is no objective evidence for you to say the customer will have this cash flow, right, in the near future. So based on that to do the restructuring. So if you haven't done that, central bank will not be happy with that. Central bank will say that you will have simply gone and reschedule or restructure the facility where customers' repayment capacity has not been convinced with the proper cash flow projection. So that means you are only postponing the inevitable. You are only trying to keep an non-performing advance in the performing advance side, right? So for that, the central bank will not be happy. They will say it's wrong, right? And the other thing is that we want to build up. I mean, building up loyal customer base is the success of a financial institution. You must always keep in mind. All right. Mediation board. This is one way of recovering, right? This is one way of recovering loans which are non-performing or about to go to non-performing. So this is a very, what can I say? It's a very cost-effective method. Before taking other actions, going to a mediation board is a very cost-effective measure. So what is a mediation board? These are established under this particular statute, Mediation Board Act 72 of 1988, and subsequent amendments have taken place time to time. So this is a simple mechanism. So the current this one, normally you can go up to loans up to 500,000, like, can be referred to this mediation board. There is nothing to say that I mean more than 500,000 you can't do that. That also you can do that, right? So normally up to 500,000 you go to mediation board. So there will be mediators, right? The mediators are appointed by the Ministry of Justice. Right, Ministry of Justice will appoint a mediators from the locality. People who are civil servants, retired civil servants, will be appointed, right, as mediators. So mediators can be minimum 5 and maximum 12 be appointed. So they will be the local mediation board, right? So what you do to the customer, you send a reminder and then send a final notice, right? You send a final notice to the customer and send the final notice and then inform refer the case to the mediation board. So mediation board actually will call the bank's representative and the customer. They will call, try to talk, right? So all the securities which have been taken, the documents, copies, certified copies should be provided to them, right, to the mediation board. So if you have guarantors, if you have taken guarantors also can be party to the case. Guarantors also can be called, right? So what this is a very decent type of kind of operation. So they will call the customers, then call the bank, and then try to negotiate and say, why don't you pay the loan? It's outstanding. As per the bank says, right? Outstanding. Why don't you pay and sort it out? Why do you have to drag these, right? So kind of, I mean, they will try to negotiate and then push the customers to settle. If there is anything the bank can, reduce or write off some interest or whatever, that also they may suggest. I mean, why don't you look at it amicably, sort it out, amicably. So they only facilitate, right? Like an arbitration, they try to facilitate. So they facilitate, and then many a times what happens is that people who don't want, the experience of, going to mediation boards, all the time in the locality. So many a time, the small loans are settled through that. And the customer will come to an agreement, okay, extend the period of repayment or something like. So with that, I mean, you come to an amicable settlement there, right? Parties try to settle. And only when the parties don't come to an agreement, they don't settle there, then the mediation board will issue a certificate called certificate of non-settlement. Right? Mention about the case, and then they will issue a certificate of non-settlement. So this certificate of non-settlement issued by the mediation board, where in the mediation process a settlement has not taken place, this certificate has to be furnished when you are going to the courts. When you go in now, if the mediation board, if you can't settle, then the next thing is the customer is a type of a difficult customer. He is not settling. He is not negotiating with the bank. Not willing. At the mediation board also, he is not negotiating. He just tries to kind of avoid. So then, with this certificate of non-settlement issued by the mediation board, you go and file a case with the civil case with the courts, right? So this you should know. Mediation board is a very healthy type of a environment for small customers or small advances, right? Commercial type of thing, of course, is difficult. They will not take. Not that they can't take. They will not normally take, right? So what is the process? So you send to the customer, ask the customer to settle the loan, right? Final notice. You send the letter of demand, right, to the customer. And then you make a complaint to the mediation board in the prescribed forms. And you inform the mediation board and inform the borrowers also. A copy will go to the borrowers. Then the mediation board members.
So excuse me.
Yes.
So whether it is necessary to letter of demand sent before mediation board? Is it essential?
It is not essential. Even if you send a letters to the borrower, request them to like a notice, that's enough. Letter of demand, I mean, there is no hard and fast rule. You should not send letter of demand. Letter of demand you can send. I mean, it doesn't say that, I mean, unless you have a letter of demand, you can't go for mediation board. But you will have to send a final notice to the customer that, I mean, please send, otherwise we are going into this particular next course of action. Right? So it doesn't really prescribe and say that letter of demand is a must. But normally when you are sending final notice, when you are sending, you need to send a final notice to the customer. That, I mean, if you don't settle this, we may be resorting to the next course of action. Right? So that serves. Right? So this is how the mediation process takes place. Maybe the mediation board process, you may be having a few sittings also. Sometimes what happens, the customer will not come. So you go there, customer will not come. Customer will excuse. And thereafter, when you go also, customer may not agree and then say, let me think and come back. So bank also can ask for time. So like that, I mean, it can take a few sittings. But finally, it has to either be settled or else mediation board will issue a certificate of non-settlement. Right? So with that only, then you will have to prepare a proxy, right, for the other process. You prepare a proxy, present to the courts and proceed under the civil procedure code. So that's the legal suit to recover the loan. Right? With that, I mean, there the customer is not agreeing, and then if we still can't negotiate, you go and file a case. So this is spelled out in the Debt Recovery Act number 2 of 1990, and then there are amendments subsequently. So it shows that it says that over 150,000, including interest, only should be referred to the courts. We don't refer anything below 150,000. So, which district court you will file action, civil suit? Normally, district courts is where the civil cases will be filed. The magistrates court is where your criminal cases will be filed. So, non-payment of a loan is not taken as a criminal case, right? So, it is a civil case. So, in the district court where action should be taken, it depends on the residence, where the borrower's residence, right? Where the action is arising, and under which jurisdiction the contract arrived, contract entered. That means the bank customer, borrower lender, contract. So these factors will decide which district court you will go to. Right? So before going, you cancel the loan agreement and you send a letter of demand. Here, of course, you will have to send a letter of demand. Right? Letter of demand is a must. So some financial institutions, it's a process. It's a procedure. Letter of demand is sent. So letter of demand can be sent even under the mediation board also. You send a letter of demand with the loan in outstanding, and then prepare a proxy, and the board of directors need to approve that. The proxy should be, they only have the authority to say, the bank to go and file a case with the courts. So they need to, a proxy, you need to get the approval from the board. And through the lawyers, you go and file a legal case, right? So in that, of course, you will have certified bank statements of the customer, the bank's affidavit, right? The documents for the case, what are the base documents? Normally, now this is what I had been telling. For a customer, if you are given a loan, and if you don't have loan application, and if you don't have offer letter signed, you will be in a difficult situation. Customer can easily say, I didn't ask for a loan. It can be a bad sin, it may be a problem in recovery, right? So even though we think that, these are simple documents, those are very important legal contractual documents where customer need to apply for a loan. If the customer has not applied for a loan, and if you are given a loan, your customer's letter of offer signature is not there, and you have dispersed a loan, you are in a bad wicket, right? So loan application, loan agreement, right? Like basically letter of offer, guarantee agreement, promissory notes signed, other issues. All these are base documents for the case, right? With that, and so the borrower's request, and then like what I told you, Bank agreeing to that is very important. Bank's letter of offer, the borrower sign means borrower has accepted, right? And the other documents like general terms and conditions, right? So decree in IC, decree in IC, you draft it, and stamps required to certify the decree in IC also prepared. Stamps for sending those documents by registered post by the courts also to be given in the proxy. With all that, banking license will have to be. These are procedural things. Banking license copy, certificate copy should be attached, and then copy of the final notice to the customer also to be attached. All these you need to have a proof that final notice has reached the customer has taken, and all that. Also memorandum and articles, names of the directors for a company, all that has to be. If it's the customer's memorandum articles having names of directors has to be given. For the company also, in the sense for the bank also, it has to be given. All these documents set will be furnished for legal process for a case, right? So the affidavit of the bank will state the number claimed and how much of personal instruments documents relied on, like those are security documents, how much is outstanding, properly stamped, those documents, affidavit signed by the principal officer. All these has to be there for the legal case. So once it is taken up with the courts, the court is satisfied, the court will enter order IC, right, for the sum to be recovered, right, and serve on the defendant, that means the customer. The customer can appear against the order IC under three circumstances. There are three circumstances if the sum stated in the order IC, what is the, which is the amount which is to be paid with the charges and all that, will paid to the courts, okay, they will appear, and then so okay, this paid, all right. Or else they will say they will to provide a guarantee for the amount. A bank guarantee has to be furnished, right? They can appear, and they will have to give an affidavit that there is an issue. So they want a case out of it. So there is an issue here. So issue can be, customer can say the loan wrongfully given, right? Terms were wrong. So many excuses. Customer due to this reason unable to pay. Some customer will have to come out with their come out with the reasons for the dispute, right? So the customer, if the judge is justified, if he is happy, then he will say leave to proceed. He will say leave to proceed. So that means the case will be tried. That means case will be taken for argument, right? Case will proceed as a normal court case. If the judge is not happy, then no, he will say that they will dismiss the appeal. They will dismiss. But if the customer doesn't come and say that, either of these things, if he doesn't say, the court will make the order IC what is issued, they will say absolute. Once the court makes it absolute, that's it, that's done. That the customer is supposed to pay, right? Customer is supposed to pay. Customer will have to pay, right? So how to implement the decision? Customer need to pay, right? If the customer has not paid to the courts and customer's argument failed and order IC is absolute, then in that case, under C Civil Procedure Code, a writ of execution will be served. So based on that absolute order NIC, the fiscal can execute a writ of execution. Writ of execution. Then that means fiscal can get the belongings, assets of the customer, and then sell it. Can come to the business and then take everything and then go and sell that. Right? If a land is there, the land can be, based on the writ of execution, land can be sold by the property can be sold by the fiscal, government fiscal, right? So properties acquired can be auctioned to recover the dues. This is the legal process basically, but the success of a legal process in this country is very remote. That's why for the whole of this so many years of banking in this country, they say in the Colombo District Court there are less than 1,000 cases filed, because the recovery through court case is it's a long drawn affair, and recovery is remote, right? But there are so enough of cases anyway, but it takes a lot of time. Any questions up to now? Are you okay?
Sir?
Yes.
What does it mean by draft decrease?
Draft? I didn't get you. Draft?
Decrease?
That is, your lawyers will know. Decrease is the one, basically, the format will be there. The format will be done by them, right? The format will be done by them. That is where the court order will be entered, right? So so in that, it's a format, right? It's a format. The decree NIC means that is the court order. For that, there is a format is there which will be filled up, and then along with the documents it will be given. So if the judge is, after going through that and then all that, I mean, this has to be paid, means if the judge is giving the order that the customer should pay, they will enter the decree NIC. That is the court order. Normally, decree NIC is the court order. He will sign and issue the decree NIC, means the court order issued, and the customer will have time to appeal. He will have to come and say, that's what I mean. These three instances we looked at, that no dispute, amount to be paid to the courts. Otherwise, bank guarantee to be paid, given to the courts. Or else he'll have to give an affidavit to say that, I mean, why he is disputing, he can't pay. So he can, come out with various reasons. So far as the judge is satisfied with the reasons given, if the decree NIC will remain, judge will call for the case to be conducted. So case will be taken for argument. Then the case has to finish before the decree NIC becomes absolute. So that's a court order, basically. In the normal terms, it's a court order. Are you okay?
Yes, sir. Another question.
Yes.
So, what is the difference between rescheduling and restructuring? Are we doing rescheduling after loan falls into NPA category or prior to falls in NPA category?
Rescheduling most of the time happens when it has gone into non-performing, right? Rescheduling is basically you are looking at kind of, rescheduling the repayment, right? So the loans you are trying to trying to put that in a way, extend the tenor, postponing some of the capital repayment now, kind of things. I mean, you do that so that you I mean, many a time it is after loan become non-performing. You go and do a resettlement. Resettlement can happen just before the thing also. Restructuring is what you completely restructure, in the sense like the entire thing of, like, you know, the composite of facilities which are given to the customer, you do a restructuring of that. Now, like what I told you, if you have given 10 ideals which has to be paid on the due date, so ideals are normally paid in 3 months time or 6 months time, ideals are to be paid, which are not paid. What you do, you put all that into a different loan, separate loan, and then you are giving a 2-year time to settle those. That's kind of a restructuring process, right? So there are, you know, very minor differences only. Restructuring will have you, the structure of the facilities, you completely change. Rescheduling is that you look at your repayment, how to extend, and then within the current repayment possibility, you will, you know, arrange the loans. So restructuring many a times happens before it becomes NPA. Rescheduling happens after it becomes NPA, but it doesn't mean that NPA rescheduling cannot happen before also. So there is no strict kind of a thing to say that, I mean, this happens before NPA, after NPA, whatever. The way you are doing that can be, the difference can be that. Understood?
Yes, sir. Thank you.
Right. So go for a break and come. We'll meet at 11 o'clock. Okay. So the Parate execution, that has a history. Basically for the banks, in the, I mean, the private banks and all that, the Parate execution was given, the right was given only in 1990. Previously, the statutes by which these state banks were incorporated, People's Bank, Bank of Ceylon, State Mortgage Investment Bank, NDB, in the statute itself, the Parate execution rights they are part of it, but other banks did not have. So now the Parate execution is a kind of a huge change in the scenario of recovery action by the banks. Why? Because earlier, only very few state institutions had that right, the bank's recovery was not happening. I mean, other financial institutions, private institutions, the recovery was not happening properly, because when you are giving against property and when you are not going for Parate, customer also knows that it can be eternally postponed, right? So legal case is something which can get dragged on. So the recovery process was not efficient, and non-performing advances portfolio was high. So those issues were there. So with the enactment of this particular special provision, Act number 4 of 1990, only that this particular Parate execution right came to be available for the private banks also, and then that changed the scenario. Basically, the customers were prompt, and recoveries were done, and then all that. So that's where, like, I mean, one of the reason how the rate of NPA came to the level of these basically under 5 or under 10 is due to this. But I can tell you one example. You know that Pramukha Bank failure. Pramukha Bank, there were so many management failures. So many management failures. One of the issue was that they had also lent, taking some property mortgages and then lent to some influential parties. So what happened? They were not given parate rights. They were given license as a savings bank, Pramukha Savings Bank, and then they had not been given parate rights. So when they didn't have parate rights, they could not recover too. Like, I mean, legal case and all that. I mean, it never happened. So one of the reason quoted for the failure of that also is that it's not the reason where the whole lot of mismanagement was there. One of that they could not recover the bad loans, which are given against property mortgages, against property mortgages to influential parties also. One of the reasons the parate execution right was not there for them. So that is the importance of parate execution. So that basically what it means is that bank can sell the mortgage properties to recover the defaulted advances without filing action in court of law, right? Under current scenario, of course, the outstanding has to be more than 4 million, right? I hope it is more than 4 million. So, parate execution, what are the steps taken by the banks? In the same way, you send a final notice demanding to pay the outstanding and accrued interest in full to the customer. Then the bank has to determine the upset price. That means what is the starting price. You set the price, and that is based on the outstanding capital, accrued interest, and other cost, right? Cost of advertising, auctioneer's charges, etc. And that also based on the market price of the property. And this is a confidential thing, not to tell, not to declare it. That's a confidential thing. So, then we make the provisional arrangement with the auctioneer. Auctioneer will do the rest of the site and obtain his written consent. Also, now there has to be agreement between the auctioneers and the bank also, right? So the legal officers need to check the land registry, any transaction which is there, and any secondary mortgages are there, or any transfers, all that has to be checked up. And then the parties should be notified. They should send notifications of all actions contemplated by the bank, such as statutory notices, sales notices, all the time. Relevant parties you need to notify, and then obtain the approval of the board, right, proposing to sell the property. And these copy of the proposal also will be sent to the borrower also, and the parties who have the interest on this property, right? Like informing them to pay the dues within 1 month. Sometimes people go and file caveat also and keep it, right? Okay, we have an interest, financial interest. To them, the financial institution, your institution, has to inform them that there is an action taking place like this. So, right. So that's about the steps of the parate execution. Then this particular, finally, you need to get the board's approval, like what you do for the legal case also. You need to get the board's approval to sell the property. And yes, the copy of that will be sent to the borrower, right? And the auctioneer will be, we would have an appointed, and then he will organize the rest of the things. Public notice has to go by way of gazette notification in 3 local dailies, right? So 3 different languages, 3 local dailies, it has to go, right? So borrower's notice will go in the registered post 14 days before the sale. Right? The notice also should be displayed at the divisional secretariat and then court premises also, and the auction to be conducted. And police assistance should be there. Police should be notified of any untoward thing happening, right? And many a time what happens is that when there are no buyers, then the bank acquires the property, right, at a nominal price above the upset price. Right? So this is the Parate execution steps. Normally what happens is that many a time the borrower will go and take a court injunction. That will delay. So the injunction, you'll take an injunction telling that it is wrongfully put under Parate and all that. If he goes and apply to the courts and takes an injunction will prevent the Parate execution. It will prevent the Parate execution temporarily. But that case has to be the judge has to issue the order. I mean, with the next this one, judge will. I mean, they will. It might take a couple of sittings. Then the judge will say whether it can be accepted or not accepted or whatever. Then thereafter, once that is cleared, only you can go for Parate again. So it's a temporarily customer can postpone also postpone the auctioning process by going into courts. The other things what you should understand is that, make a note of it also, Parate execution is allowed only for if the party is mortgaging, right? No third party mortgages. On that you can go for Parate execution. That means if you go for a loan and if you have taken your friend to give his property as security, you can't go and do a Parate execution, right? You can't do that. That's not allowed. For that, somebody will have to go to, bank has to go to courts only, right? That has to be through civil thing only. Security is there, but the enforceability of Parate is restricted because it's a third-party property. So third-party properties you can't, right? Can't. That's about these recovery procedures. Any questions? We have comprehensively covered this area also.
Excuse me, sir.
Yes.
In the third-party mortgage, if the property owner is joined as a party in the borrower, can we do the Parate execution?
Yeah, third party, if he is a party to the borrower, he is a first party, no?
Yeah.
Yeah, if he's a first party, there's no third party because he also is a borrower. So borrower's property, okay. If there are cases where the owner of the property is only the obligor mortgagor thing is there. The obligor is the borrower and mortgagor is the party who is giving the property. So if the obligor and mortgagor is different, is the problem. That's the third party. Normally, when you have third party property, this clause will be there, obligor mortgagor clause. Who is the obligor, who is the mortgagor? But in case both are same, no issue. You can go for Parate, provided that is above 4 million outstanding, when you're going for that. But if it is different, it is a third party, not allowed. Right?
So, excuse me, sir. If a company has taken a facility and one of its directors are mortgaging the property, it is taken as a third party. But due to recent cases, even the director interest is taken as the company's interest and considered as a part of the facility, isn't it?
Yeah, now I think there are decisions which are coming that way, because here the spirit of the thing is that what happens is that even though it can be considered as a third party, here they are the party, they are business. For their business, it is they are kept the property and obtained. So the beneficiary also of the loan also, the directors have a I mean it is going to their benefit only. So currently the argument of directors is a third party cannot mortgage is being challenged, and then it's being accommodated also. Because it's different here. It's different here because the same parties only, they are the directors, they are the owners of the property, and they actually borrowed, and then it is for their business interest. And mostly those are private limited liability companies. And then you look take the look behind the veil. We say look behind the veil in the sense who is behind this, and they are the parties. It's only a matter like it's about the companies are cover, but to their benefit. So when it comes to companies, yes, what you say is right. Any other questions?
Thank you, sir.
Right. Okay.
Excuse me, sir.
Yes.
The parate execution applicable amount is 5 million and above now.
Yes.
Is this loan granted amount or outstanding amount at the time of execution? Which one?
Outstanding amount at the time of execution.
Even if we granted the loan for 8 million and the present outstanding is 4.5 million, we can't do, no?
You can't do. Outstanding at the point of you going and exercising the parate execution.
Okay, sir. Thank you.
Right. Okay. Okay. So we pretty much covered. I need to. I will be speaking to you next week on the IFRS 9. One thing is that requirements of Basel 3. Basel 3 capital adequacy requirements and little bit which we covered anyway. Liquidity coverage ratio, net stable funding ratio, those little bit we will cover, and Basel 3 capital adequacy ratio, and then the impairment provision related some knowledge under IFRS 9. We will speak a bit. We have spoken about Basel 1, Basel 2 and all that. Okay, in the Basel 3, how the thing which currently is operating in the market, and of course the impairment provision side of it. We'll try to speak next week a little bit. Now, let's look at a paper, right? Let's look at a paper. You have that shared with you. Now, the thing is that this discussion, what you are going to have, is only a discussion of, so what probably will be expected from you is not, I don't believe in dictating any answers. Answers, of course, writing is your forte, but I will tell basically what is expected of you, what you are supposed to do. That is a discussion, because at postgraduate level, dictating answers is not the done thing. So I will not be dictating any answers. That is up to you to sort of write your answers. But I will guide what is the expectation. And normally in these kind of papers, the basic thing what you should keep in mind is that it's a 3-hour paper. right? 3-hour paper means basically you have 180 minutes to answer the question. So you need to program yourself that 180 minutes, how you are going to spend, right? So one easy way for you to do is that say the structure will be like, you will be asked to answer one question which is 40 mark and then another 3 from multiple choice, not multiple choice, I mean to say another number of questions. You will select 3 more questions totaling to 60 marks. So 20 mark questions will be there. From that, from about 5 questions, you will select about 5 or 6, you will select about 3 and do, and 1 compulsory question for 40. So altogether 100 marks. So what you have to do is, number 1, what is the time you are going to spend on the question is important. For example, 180 minutes, right? 180 minutes is there. So you divide it by 100 marks. So you get 1.8 minutes per mark. 1.8 minutes per mark. Even otherwise, let us say you take about 10 minutes time to read, right? You take 10 minutes time to read, just go through this, so you take 10 minutes time. So then you have 170 minutes. 170 minutes, you then divide it by 100. So you have about 1.7 minutes per mark. That means for that you can say that, I mean, if it is a say 40 mark question, 40 into 1.7, say you can spend about a little over 1 hour, right, on that question, because that's comprehensive. 40 mark question is comprehensive. About 68 minutes can be spent. So you need to be careful. Okay, let me work for about 1 hour, little over 1 hour, and if I haven't completed, I will go to the next question. Let me do that, and then if I can save some time from there, I will come back here, like that. So a common thing is that spending more time on this is at any level the mistake which is done. Spending more time on one particular question and writing more than necessary. Writing more than necessary. So that I mean that you need to prevent. So here, like what I say, if it's a 40 mark question, you are spending about 68 minutes only, not more than that, right? If you see that, I mean, it's going to take more time, at certain point you must stop and go to the next and then do that, right? So that you don't kind of miss out on because however much on a 40 mark question, however much you write, only 40 marks. You have another 60 marks to earn, right? Okay. Then subsections also, you can look at it. Now, like, I mean, okay, a 6 mark question is there here. 6 mark question into 1.7, it can be about 10 minutes. So you should be able to write an answer within 10 minutes time, 10.2. 10 minutes time. You don't write a long answer, right? So time management is very important. Like that, with a 20 mark question with 3 subsections. Every subsection, one will be 10 minutes, another 10 marks, another one will be 5 marks, 5 marks. Like, I mean, so if it is a 10 mark question, you are going to spend about 17 minutes on a 10 mark question. If it's a 5 mark, means 5 into 1.7, right? 5 into 1.7 is going to be 8.5 minutes on a 5 mark question. Sometimes people write a 5 mark question like a 20 mark question. I mean, however much you write, you are going to get only maximum 5 marks. Right? So no point in spending time. So that's one of the exam techniques. If you do not know, you must keep in mind. So the basic, but I thought of telling you, is very important. right? Then of course, some students have an approach of looking at and then seeing that where they are very comfortable, they know for sure, and then they can write fast. They will go and attempt that, and then come back to the thing which they have little doubtful. Yes, that's okay, no problem, because no examiner is asking you to write the answers in a particular order, right? You can answer, so far as you know that which question you are attempting, which section you are attempting, you are writing, you are okay. So those basics for you in writing a exam. So this particular thing I have come across many a time with the students who have spent a lot of time with this 5-mark question, lot of writing. You can't be writing for 1.5 2 pages on a 5-mark question. 5-mark question is like, you are talking about 8 minutes. 8 minutes, how much you can write? 8.5 minutes. So you let precisely you let write. So quantity is not all that important. What you write there is what is important. So it should not be too short, it should not be too long. Okay. So to the point, right to the point. So those are basics, right? Then coming back to the questions, let's take this question number 1. We are taking this question number 1. Look at it. What are the sources of funds for a financial institution? Explain the advantages and disadvantages of sources briefly. So now in this, what is more important is that you must mention what are the sources, and then very briefly you will mention what's advantages, what is disadvantages. It may be easier for you when you put 3 columns. One is sources of fund, advantages, disadvantages. You put 3 columns, and then in that when you write also, it's much faster. Then you will say, well, what are the sources of funds? You will say that okay, equity capital, right? Equity capital. Then debentures. Then the interbank borrowing. Then you have interbank borrowing against securities. What are the securities you keep? I mean, the treasury bills and bonds, and you keep, and interbank borrowing you do. Else, swap the foreign currency holdings and all that kind of things you can raise. And then you have the deposits, customer deposit. There's a prime one, right? Prime. So you write, and then advantages and disadvantages on one line. Just quickly you write and go. You don't waste much time, right? And you get full marks. Okay. So that's easier. I mean, it doesn't mean that you need to put 3 columns and write also. That's a way there you can save your time. Even number 1, number 2, number 3. You say write that customer deposits, advantages. What are the disadvantages? Like, I mean, one if you write, that's enough. You can't write more, no? Because there is only very little time here. You just can't. Sometimes people get carried away, and then this answer they write for 1.5 pages. So I can pretty well say maybe about 15-20 minutes would have gone. 15-20 minutes you would have spent on that, but only for a 6-mark question. That means that is going to put a lot of pressure on the other areas, right? So that's the exam technique. That's how you write. That's how you earn the maximum. Okay, so I don't need to elaborate on what are the sources in advantages, disadvantages. We have looked at all these areas. Okay. Then there is this question you will find. There is this, looking at how you analyze your P&L balance sheet. How do you analyze and then come to conclusion? So this is an exercise you will have to do, right? So it says the following financials are received from Lanka distributors. The company is involved in wholesale purchase of hardware, accessories, and distribution around the island. They also have 5 branches in strategic locations in Colombo. You are required to calculate minimum 2 financial ratios from each of the following categories. So you are going to look at their profitability, their liquidity, their leverage, right? Their performance or activity ratios you are going to look at. So minimum 2 you will do under each, and with your comments, it is going to get you 16 marks. So this is something never to be missed, right? Never to be missed. Your 16 marks you can't afford to lose. You need to write. So you need to know your basics of the financial ratios. So okay. Profitability ratios, there are so many ratios. So popular ratios are like, gross profit ratio and net profit ratio, right? Gross profit ratio and net profit ratio are the popular one. You also can look at operating profit divided by turnover sales. That is a operating profit ratio. And you can profit before tax. You can say profit before tax over turnover gives you profit before tax ratio. So like earning before interest, taxes, depreciation, and accruals. Those things also can be EBITDA, EBIT, the EBITDA over sales. So there are many you can do. Minimum requirement is 2, right? Minimum requirement is 2. So 2 you must have done on the profitability. So these are all revolving around your profit and loss account. When you are given 3 years now, like you see, you have been given 3 years of income statement. When you are given 3 years of income statement, you must put columns, and then for all 3 years you must do. So keep that in mind. Some of the students go and do for 1 year. In 1 year you can't, as we studied, you can't do anything. You can't do any comparison. Ratio is about comparison. Year to year you will compare. So if you can't have do the comparison year to year, and there's no point. If you compare, if you calculate for 1 year, is it going to give any meaning to you? Okay, their gross profit margin is this. Their net profit margin is this. So what? But if you have previous year before that, then you can look at the trend. What is the trend? Are we the gross profit is increasing or decreasing, net profit increasing or decreasing? That gives a trend to you. Then from that you will be able to predict, okay, business is doing okay, doing well. Their year on year, their turnover is going up, their overheads are coming down, then their profitability is going up. So like the trend you can look at, right? The trend you can look at from those ratios. So ratio is about comparison. Comparison you have to do for 2-3 years. So any student who is doing for 1 year and then putting the time you are done, you are losing your marks. Right. Now see, you have on top you have your sales figure and you have your gross profit figure. So GP margin, you take 2016, 17, 18 given here. So you will say that here gross profit is 435,000. So that's about 435 million, because this is given in triple zeros. So 435 million divided by 1,375 million. That gives you gross profit margin. And all 3 years you will calculate 650 divided by 1,800, 900 divided by 2625. All this gives your gross profit margins for 3 years. The same way, in the same table you can do all these ratios. The same table, you have 3 columns, and down below you will put gross profit, net profit, operating profit, margin, other things if you want you can put, provided you have the time, right? So the calculating your profitability margin is easier that way. Once you calculate the profitability margin that way, and that margins, that ratios comparable, and comparable, and then you can write on that, right? So okay, profitability company is showing. If you look at it even by absolute terms, the numbers are increasing, sales is going up, cost of goods sold also correspondingly increases, but the profitability is showing good increase in this, so that should reflect in the ratios, and how your operating expenses is behaving, that also is increasing. Then your profitability, you will like operating. I mean, basically your answer to, normally, even if you write on 2 and write the proper understanding from that is enough, right? Okay, then net profit, and then all that, I mean, from this, I mean, from the trend you can write what is the trend of that. Then you are looking at your liquidity. So liquidity, basically looking at how liquid is the company, so that, I mean, they can repay their loans, right? Repay their loans. So liquidity, the current basic thing is that we talk about, in the balance sheet. You have the balance sheet. In the balance sheet, we look at the current assets and current liabilities. So the very widely used items from the balance sheet, current assets and current liabilities. So normally current assets, you will find that all these cash in bank balances, stocks and receivables, short-term investments, and all that will be there in your current assets. You take the current liabilities, you will have your trade payables, you will have other, accrued payments and all that, what you have to make. So the bank, within 1 year, whatever bank commitments to be paid, loan installments, what has to be, all that will come in the current liabilities. So normally for a business, even if you are asked to find out what is the working capital, whether working capital is positive or negative, you will just simply deduct current liabilities from current assets. So current asset minus current liability, basically taken as working capital, right? That's called. Yes. Go ahead. Right. So then the current ratio. What is the current ratio? Is that current assets divided by current liabilities. Current assets divided by current liability gives you current ratio. So what do you understand by that? Whether currently the business is a, yes, go ahead. Anyone want to speak? Okay. I hear some sound, but then I don't hear anyone talking. Right. So the current asset divided by current liabilities gives you an indication that whether with the current assets the customer is able to pay the current liabilities. That is because we are taking all these what is going to mature within 1 year period normally, current asset, current liabilities. So if the current liabilities cannot be met with the current assets, that's not. Yes. So that's not looked at healthy. So current ratio, current asset divided by current liability, current ratio. So that is one of the liquidity. The other one, you look at the quick asset ratio, or quick ratio you call it, or acid test ratio. All these are same. Quick ratio. The quick ratio is basically in the one of the problem with this current asset is that we have the stocks mentioned there. The stocks, even though theoretically we think that, I mean, these are current assets, stocks may not be that much liquid. You can't, when you want, you can't liquidate the stocks. So that's why the quick ratio is calculated, taking this stocks figure out. You take the stocks figure out. That means current assets minus stocks. You take the stocks inventory, average inventory, what is there, you take it out. And then you divide it by current liabilities and then see. Then maybe many a time it can be below 1% also. But then it will show how the current liabilities can be met. To what extent the current liabilities can be met with the current assets which can be turned to cash within a very short period of time. So that's where the quick ratio comes into significance, where you find that absolutely with the cash bank and then short-term assets and all that, whether the customer will be able to meet the current liabilities. That shows, and then that percentage. So anything current ratio, anything above 1, you will say that okay, customer is in a comfortable situation. If the current ratio is below 1, yes, there is cash flow issues the customer will have, because if at any point of time, if the current liabilities are to be liquidated, he will have difficulties. And quick ratio normally, if it is more than 1, very solid. If it is less than 1, also to what extent? Right? Okay. So that's about the liquidity ratio, current and quick ratio too, you can say. You can look at the, what is the net working capital, what is the cash ratio, right? So cash will basically say what is absolutely cash, right? Cash and short term, any investment, immediately you can take the cash. So cash ratio will show, cash divided by the cash and short term investment divided by the current liabilities. Cash. So these things will be the liquidity ratio that basically shows about how liquid the business is in meeting the commitments, right? Liquidity. Throughout the course, we have been talking about liquidity a lot, whether it is a bank or whether it is a customer. Liquidity is very important, because for bank also, liquidity, when we are not able to meet our short-term commitments, bank can fall into kind of a bank run, right? Okay. Then you come to the leverage. Leverage is what? How much borrow? Okay. How much borrow? How much the business is borrowed. So leverage to show like, okay, you will compare the equity with that of the borrowed funds, right? How much of borrowed, and then say that like whether the company is in a comfortable position. Now, normally leverage ratios we have looked at, okay, debt equity we have looked at, right? So debt equity ratio is basically for how much debt, how much equity is there, right? Debt to equity, if you say, like there are 2 ways also to be done. The total debt, short-term, long-term debt divided by the equity, or else the debt divided by debt plus equity. What is the total fund? Out of that, how much is borrowed? So both can come. Both can come when you're talking about the leverage ratio or debt equity. That means debt as a numerator. In the denominator, you will put the equity or equity plus debt. So equity plus, that means the total capital of that, how much is the debt, it will show. One other way you can find out is that debt divided by assets. You see in the balance sheet, 2 sides are there. One side is asset. The asset is completely financed by, at the beginning we looked at, the asset is completely financed by the equity and the liabilities, right? So what happens is that the total asset side, right? So when you are putting the debt on the numerator divided by the assets, that shows of the assets how much is the debt, of the assets how much is the debt. So that is debt to assets, right? So how much leveraged in different ways? Debt to assets, you can say. Debt to equity, you can say. Debt to earning before interest taxes in EBITDA. Asset to equity, you can look at different ways. Asset to equity is total asset, and then how much of equity is there. So now, like what I told you, in the balance sheet, one side fully assets, and when you divide it by the equity, you will say how much asset is the multiple of equity, right? So if the equity, if a business is completely financed by the equity, it is going to be 1, right? It is going to be 1. Asset divided by equity is equal to 1, because asset is equal to equity. There are no borrowed funds. But if the borrowed funds are increasing, right, asset will increase. So what will happen? It will be more than 1. So asset to equity is more than 1 means by that amount there is borrowing, right? So different ways. You can choose any 2 and then put 10. You can compare and then say there how much is leveraged. So leverage basically talks about how much of borrowed funds in play in the business, right? So the next is performance or activity. Now performance or activity ratio. So performance ratio is how the turnover, right? How many times the inventory has been turned over, right? That's an activity. How many times now when you go and look at inventory, you have about 5 million inventories there, and you have the cost of goods sold is about 100 million. So 100 million divided by 5 is going to be 20 times it has been turned over, right? 20 times it has been turned over. Very good. It has been turned over. It depends on the industry also. So 20 times it is turned over. Inventory turnover is 20 times. That means 360 divided by 20, you will say how many days. If you are asked to give the days, it will be now cost of goods sold divided by average inventory will give you how many times during the year the inventory is turned over. Now in this figure, when you are calculating the inventory turnover, you can use average inventory. You can take 2 years and then put an average. Or even if you use the current year's inventory, it's not an issue, right? Almost this one. So inventory, cost of goods sold divided by inventory is going to give the inventory turnover, how many times it is turned over. So like what I told you, you have cost of goods sold about 100 million. You have now in this example itself, let me see how much of the inventory. You can say cost of goods sold for an year 1,725,000, right? In 2018, 1,725,000. In the same year, if you say the inventory, you have 575 million, 450 million. You can take 2 years and then average it and put it. Or else, even if you take the current one, I'm not going to find fault with that, right? Inventory. So cost of goods sold divided by inventory, it gives here in this case you have for 1 year if I take. I told you it is cost of goods sold 1,725,000. 1,725,000 going to be divided by your that inventories you have 575, 450. You can put 10, put an average. So it comes to about 1,725,000 divided by 925,000. So divided by 2. You get about 3.7. 3.7. The 3.7 is going to be what your turnover, how many times it is turned over. So now normally what happens is that 3.7 for a year. So 360 divided by 3.7, you normally get about 97 days of turnover period. Right. So now you calculate your inventory turnover, data's turnover. Data's turnover basically sales divided by average data's. Inventory turnover, cost of goods sold divided by average inventory. You can also calculate working capital turnover, right? Working capital turnover will be like, sales divided by average working capital. Asset turnover you can calculate. Asset turnover will be sales divided by average total assets. That will give the how many times the assets are turned over to create these assets, sales, right? Asset turnover, debtors turnover, inventory turnover, working capital turnover. So with a trend, you will be able to say. So this is about, you're calculating your different ratios, which not only in this case, in many other courses also, you would have been studying the same thing, right? So you are going to calculate. Now you're calculating with a short note on that. You're going to get 16 marks. Keep in mind, right? So that's about your ratio calculation. Then comes the next part of 10 mark, 8 mark questions also. In view of the fact that the company has requested for a term loan of 100 million repayable in 5 years period to construct a warehouse facility in stock high turnover items, analyze the position of the company using the above ratios. Then with these ratios, you have tabulated the ratios. You have the ratios. With that, you will have to give you a prediction, right? You will have to write about to say whether the company will be with the current liquidity position, whether the company will be in a position to repay the loan comfortably, right? Monthly commitments, monthly installments, whether they will be able to repay the loan comfortably. So that's what you will have to go and, so look at the ratios what you have given. Look at the profitability, look at the liquidity, and then you can calculate your debt service coverage ratio also. Your debt service coverage ratio is basically going to say how you will service the debt. So debt service coverage ratio, basically you will look at earning before interest, taxes and all that, divided by your total loan commitments, right? So your loan commitments, your total, for the year, what is the loan commitment? So by your loan commitments, you will go and divide your earning before interest, taxes and depreciation and all that. Sorry, earning before interest, taxes, depreciation and accruals. You put in, you calculate your EBITDA, I mean DSCR. Then with that you will get, say that this customer can repay this particular loan comfortably. That's all needed. That's all needed, right? Any question here?
Minimum DSCR, what amount, sir?
Okay. So you have your current maturity of long-term commitments within 1 year what you have to pay, right? Which you need to which you need to pay, right? And then your figure here in your profit and loss account, income before taxes, right? Okay. You don't need to go to that also. You have your interest expenses, which is given here, right? Interest expenses given here, 3.4. Can you see that 3.4 million, 3.8 million, 2.9 million? You have the interest expenses given here. So that means you have your income before your interest and taxes and all that. You take that figure, and then this commitment plus your new commitment, which is going to come. So you total it up, and then you divide it, and then you will know. Give me a minute. I'll get back to that. So for your easiness, of course, your net operating income you will have to take. Okay, total operating expenses, operating income. Net operating income you will have to take, and you will be dividing by your current commitments. What are your current commitments? Okay, here it is mentioned 3.4, and the new loans, how much you have. You can total it up and then put in. You can say that, I mean, customer can comfortably pay the current commitments with that. That's debt service coverage, right? Your normally the formula what you will use is that net operating income divided by the what is the debt service, right? Debt service will include the interest, any lease payments or any principal repayments that you have to make, that you can take into account. So you have these operating income, you have these interest expenses, and then you have these current loan outstanding what you'll have to pay, and then you have your current maturity of long-term borrowing also is there. So all that you will have to total it up. Right. Okay, you do not have in the current assets, current liabilities. You do not have that. Okay, current liabilities you are taking into account, right? Okay, so the account current maturity of long-term borrowing you will have to take into account. With that, your current the loan 100 million, the installment what we are taking, that has to be taken into account. The interest commitments already in the P&L you have, you total it up, and then your operating income divided by that, right, is equal to DSCR. Any question?
So can you please work out one on the board?
I can get you.
Can you please work out that on the board, sir?
All right, okay, I'll show you. Can you see the board?
Yes, sir.
Right.
Yes, sir.
Right. Now your operating income is how much? We have different, let's say different years. Here we have 18, 17, 2018, 2017, 2016. Okay. You have your operating income of 370,000, and you have 204,000, and then you have your 78,000, right? So your commitments are going to be your capital and your interest, how much you have to pay. Is interest expense is coming there. Your interest is how much? 3,400. 3.4 million. 3.8, and you have 2.9. Right? And you down below, if you say the current in the balance sheet, the current liabilities, you see the figure. The current liabilities, you see current maturity of long-term borrowing. You have to pay how much? Current maturity of long-term borrowing. You have 37.5. And 24, 3, and 15. Right? Even so, if you take these two, how much is this? We are going to take these two. Right? So when you take that, your debt service coverage ratio basically talks about your operating income divided by your commitments, right? Your commitments. Okay. So your commitments totally, it may be that's your current interest plus capital installments payable. So in this, you will have your divide this operating income by this amount, and you will get debt service coverage ratio. How many times of your debt service amount is your operating income? That means you can comfortably service the debt service coverage from the operating income. That's what basically means. So that means if I take the figures, this company is in a very comfortable situation. So when I take all that, it's about 40,900, 370,000 divided by, let me write here, DSCR will be 370 divided by 4,900. It's about 9.04. You take here 28,100 divided by 204. Divided by 28,100. 7.25. It's about 78,000 divided by 17,900. 4.2. So your DSR comes, your operating income divided by your current maturity of borrowing and the interest also. So your ratio comes to DSCR 9.04, 7.25, 4.35. That means the debt service coverage ratio is improving year by year, right? 4 to 7 to 9. So when you're talking about this, even if you increase the 100 million, they are asking for a loan. So 100 million they are asking for a loan. Let us say you are payable within 5-year period. So divided by 5, so let us say 20 million. 20 million, if it is going to be increased by this, right? Even if it increases by 20 million, this is going to be what? 60. 20 million plus interest. So it's going to be about 60 million. Still 370 divided by 60. Let's say 61 or 60. Still it's going to be above 6. Even after giving the new loan, this debt service coverage ratio is going to be 6, like 6 point something. So you will say comfortably the customer can repay the loan. So debt service coverage ratio basically speaks about how much from the current operating income the customer will be able to service all his commitments to loans, leases, other installments. Any question?
Sir, excuse me, sir.
Yes, go ahead.
When calculating the DSCR, aren't we taking depreciation and the long-term debts as well?
Wait. Right. Okay. No. The operating income, what I have taken here is that, after depreciation. Okay. Okay. Now, two ways of calculating. In the ratios, two ways of calculating. One is that, see, you take the net operating income and take the annual obligation. At times we do take depreciation, sometimes we don't take, but then true enough, what you say is correct. Depreciation also should be added here. In that case, 730, 370 plus depreciation you must take. After general administration, yeah, 370 plus 41. Yeah. In this calculation, 370 plus 41. 341. 370 plus 41. The other one is 32. The other one is 24. 24 you can, yeah, add it. More acceptable thing is this anyway, but to be more stringent, we without taking that, we do that because this is a book entry. As far as depreciation is concerned, it's a book entry, so we can avoid it to get the correct position. So that's what I say. In the ratios, you know, at times calculations differs. You know, there are certain calculations where people don't take the depreciation and then take the operating expense, but then that will be more stringent when it comes to that. I mean, you know, like, I mean, the way to say that, I mean, it may be difficult to justify a case. So depreciation including EBITDA, we call it EBITDA, earning before interest, taxes, and depreciation and accruals can be taken in the calculation. So what you are saying, right, under these circumstances, you can include the depreciation also there. So 370 plus 41, then you will do the calculation. That's okay. Any question? Any question?
Excuse me, sir. When the DSCR is favorable to bank and customers, why the approving authorities request to reduce the term?
I didn't get you. When the DSCR is?
It's favorable, like 4 or 5. It's come as 4 or 5. Why the
Okay.
approving authorities request us to reduce the repayment term?
When the DSCR is comfortable, why they are asking the customer to reduce the repayment term?
Yeah.
Okay. See, DSCR is only one component, right? But it doesn't really mean that everything else is okay. So there may be other reasons due to that. The lending authority thinks that, I mean, you will have to, you know, reduce lending or bring down. DSCR, by which we can say that, I mean, with the earning before interest taxes from that, how much, how they can repay the loan. That's one part of it. That's one part of it. There may be other reasons why like, for example, if you take the particular venture into account, maybe they might have felt that the customer's contribution is not sufficient. You need to increase the customer's contribution given this particular trade, this particular investment. So we can go and say that, I mean, no, your equity part is not sufficient. You will have to increase it and say that. So that's what I say. These are things which are basically one indicator. Solely on the strength of one particular ratio, you don't take the decision. It will be a composite of so many other things with that only. So maybe other criteria was not sufficiently met. Maybe because of that, your lending officer is not going to go by basically only by the DSCR. DSCR is one of the criteria, but there may be other criteria where the customer has not met the expectations, or it may be a risky industry, right? Sometimes when the industry's risk is high, even though DSCR is okay, still we will say that no, your contribution should be high, right? So what I think is that here there are other issues for the lending officer to say that you need to restrict. So they don't go by purely by the DSCR. Okay.
Okay, sir. Thank you.
So you are going to talk about your different performance, and then you are going to look at this particular loan what you are going to give, and then with that you are going to say within 5-year period whether you can comfortably can pay the loan, and then by investing in these, what is the value addition to the company which is going to accrue? Maybe that because they are putting up this warehouse, their rental is going to come down, right? So warehouse facility, maybe currently they may be paying rental, and then getting that rental may be coming down. That will increase their profitability, right? And when it comes to strength of the asset also, the asset value can go up in future, and then the mortgage mortgage asset value can go up. That may be good for the bank. Repayment capacity is okay. With the cash flow, the customer will be able to comfortably meet the repayment. I mean, these things you can mention, and then you recommend, right? Explain whether the requested term loan as mentioned above can be accepted if you feel that information, the information what is purely given with the balance sheet and P&L may not be sufficient. You may have to look at their project cash flow, right? Cash flow should be projected over a period of 5 years, how the cash flow is going to work. You need to look at the cash flow. You need to look at the asset documents. They will have to furnish all the documents relevant to the asset. Valuation, you will ask for the valuation. You will ask for a survey report and projection after getting. You will look at that. So you will ask all these details before you are saying that all right, we can go ahead, right? For your evaluation, you will need more information than this. So those information has to be mentioned. If you feel the information provided is insufficient, elaborate on other information required to take a decision on the loan request. That's where you will look at all these. What is your project? What is your projection? Cash flow, right? What is the valuation of the property? What is the title with the title clearance report? Okay, cash flow and all you will take. Cash flow projection you will take. Yeah, at least basically those things you will ask for, right? So those things you'll have to mention here as the additional documents you will ask for. Are you clear about the question 1? Are you okay with the question 1?
Yes, sir.
Okay. So now when you are looking at what you have done, you have answered a 6-mark question, that is your theory knowledge. And you looked at, and then you did some ratios on about 4 areas: profitability, liquidity, leverage, performance, and all that. You did some ratios. Based on the ratios, your conclusion that whether a customer can go for a loan facility comfortably, whether he can pay, you commented. And then also you said that what kind of additional information depending on this particular project you will ask from the customer, before you come to a conclusion that you can give a loan. So those are the things which were asked for, and then you have earned 40 marks. And so that keep in mind, you don't try to skip this and then try to get through the exam with 60 other. Some students have attempted, but unfortunately you may not get through with that. This is important. Okay, so we spoke about asset liability committee, how it is important. Now question number 2, there are 3 questions asked. Like what I told you, 10 mark question, 5 mark question, 5 mark question. So 20 mark question. So this basically, this asks about as a ALCO, asset liability committee. And this asks for deposit insurance. This asks for credit policy, right? So like what I told you, you need to keep in mind 10 mark question. How much time you will spend? You can spend about 17 minutes time. 5 mark question, you may spend about 8 minutes time only, right? 7.5, 8 minutes. So you must know that how much of time on which question you are going to spend and then answer. So ALCO plays a vital role in the prudent management of a financial institution. Discuss the composition. So you will have to talk about what is ALCO, right? How it is composed of, who are the members, what is the role, what is the responsibility, right? All these we have discussed, right? So that precisely you will mention. Say this is, ALCO, what is their basic function, right? How that is composed, right? We said, ALCO can be board level committee, management level committee, right? Board level committee, of course, board chairman will head it. Management level is CEO or managing director will be the chairman, and then all the business heads will be part of it, and the treasury will be the secretary part. Treasury will run the ALCO meeting. And then what are the roles and responsibilities? They are the this is the committee which will decide on the fund, how the funds to be sourced and how the funds are to be, what are the areas to be used, any new products coming, the rates to be decided, interest rates and all are decided by the ALCO committee month on month, and any products to be stopped or whatever, any new investments to take place, anywhere they will have to borrow, whether they have to raise funds through equity capital, whether they have to raise funds through debentures, all these are decided at the ALCO committee. So you will give a brief of that. And it's about ALCO. So you get 10 marks. Then what's deposit insurance? We learned about deposit insurance. What is the amount currently paid under the scheme, under what circumstances? So deposit insurance we looked at. The statute governing deposit insurance we looked at. Currently it's about 600,000 deposit insurance can be paid if a financial institution falls into trouble, and then the customers up to 600,000 the customers are paid, right? So under what circumstances this happens, you'll have to say, right? And so that's basically, it's a 5 mark question. So you can't take 7 to 8 minutes time, more than that you can't take, right? So you'll tell about what you understand by deposit insurance. You have to say how much is the amount paid and what are the circumstances under which the deposit insurance will be paid to the customers, right? Then you look at the credit policy. Why it is important for a bank. Now keep in mind this is a 5 mark question. On a credit policy you can write a 10 mark question easily. You can write about 1.5 pages without a problem. But if it's a 5 mark question, you can't spend more time. So you'll have to say what you have to say precisely, right? So credit policy is a important document of a bank, is a policy of a bank which decides the direction of the institution in its lending practices. Is the basic guideline for all the lending officers of the bank. So what are the things basically in credit policy spelled out? You will give. So that will fill up about half a page to 3/4. That's enough for you. Not more than that. You can't write more than that. You have no time, right? You'll say that credit policy is this, and then what are the components of the credit policy? What is the importance of that? So briefly you write. So half page will be enough. Little more than that you're writing, that's okay. You can't write more than that, right? So that's the importance of you really timing your answer. You have to time your answer, the time you are taken to write an answer. Okay, so rest of the questions we will deal next time. I will come with another presentation I need to discuss. I told you we will look at a little bit on the IFRS 9, the provision side of it, impairment provisions importance, and these IFRS and Basel III capital adequacy ratios a little bit. With that, we will look at the rest of the questions. So then, of course, only one more question paper if you can look at. That's okay. I hope I should be okay with you. Any questions? Any questions? Are you all okay with this? Anything you did not understand? In ratio analysis, keep in mind that ratio is a relative thing, calculation. So what happens is that people do calculate sometimes in different ways, but then so far as you are writing your way of calculating, this is the relative figures. It's a relationship between two figures. These two figures, this is how we are calculating. So when you say that, I mean, this is how the calculation is done, and you give your interpretation from that, and that's it, right? So there can be differences, different ways of calculating ratios. But you need to say what is the method you have used, what are the relative terms you have taken, and then you give your answer properly, right? And then your predictions. Any question? I hope we have covered, basically the syllabus has been covered. Questions to be discussed, some more questions to be discussed. With that we are done. Anyway, I will spend a little time because the impairment provisions are taking center stage now. Lot of so that we will look at a bit on the IFRS because the provisions are a little bit confusing. One thing is that what we learned about central bank's provisioning requirements. After that, you have after central bank you have IFRS. That's the published accounts. IFRS based thing, and I told you also that even income tax department also they will want to separate tax calculation in a different way taken from this. So it's a little complicated. But impairment IFRS 9, what does it say? Because it affects our profitability, declared profitability. We will have a small discussion on that. So with that, our syllabus will be over. Okay, are you all okay?
Okay, sir. Thank you.
All right.
Yes, sir. Thank you.
Yeah, we will meet up next week. Have a nice weekend. We will meet up next week, and those areas we look at it and we will wrap it up. I probably will get some time and then start correcting your assignments during the week, as well as with that one we'll finish, and then I probably feel that your exam time will be when is going to be your exam will be informed by the institute. Right. Okay. Thank you.